Tax refund mistakes. Don't make these serious tax errors and oversights. One of the most frequent reasons taxpayers receive a lower refund than anticipated is failing to account for changes in their income and withholding throughout the year. If you received a significant raise, earned a performance bonus, or worked a second job, your total annual income may have pushed you into a higher tax bracket than what was calculated on your individual W-4 forms. Since each employer only withholds taxes based on the specific salary they pay you, they do not see the big picture of your combined earnings, which often leads to under-withholding. This discrepancy is particularly common for those in the gig economy or freelancers who do not make quarterly estimated tax payments to cover their self-employment liabilities. Consequently, when you file your year-end return, the IRS applies your total tax liability against what was actually paid, and any shortfall is deducted directly from your potential refund. Another significant error involves the miscalculation or overlooked eligibility for high-value tax credits and deductions. Many taxpayers rely on legacy credits they've claimed for years, such as the child tax credit or the earned income tax credit, without realizing that these programs frequently undergo legislative adjustments or have age-based phase-outs. For example, if a child turned 17 during the tax year, they may no longer qualify for the full $2,000 child tax credit, shifting instead to a much smaller $500 credit for other dependents. Missing out on newer deductions, such as those introduced by recent legislation like the One Big Beautiful Bill Act, can leave money on the table. Taxpayers often fail to research these complex eligibility rules, income thresholds, and specific filing requirements, which results in either claiming too little or having the IRS manually reduce the credit during processing. Simple clerical mistakes and mathematical errors remain a leading cause of refund reductions and processing delays. Even with the prevalence of tax software, human error in entering Social Security numbers, misspelled names, or incorrect bank routing numbers can trigger an automatic adjustment or a math error notice from the IRS. If the names and identification numbers on your return do not perfectly match the records held by the Social Security Administration, the IRS may disallow certain exemptions or credits entirely until the data is verified. Furthermore, basic arithmetic errors such as failing to combine income from all W-2s and 1099s correctly can lead the IRS to correct your return in a way that favors the government. These automated adjustments often result in a smaller check being issued before the taxpayer even has a chance to explain the discrepancy. A less obvious but highly impactful reason for a diminished refund is the Treasury Offset Program, which allows the government to intercept funds to pay off certain non-tax debts. If a taxpayer has delinquent federal student loans, past due child support, or outstanding state income tax obligations, the Bureau of the Fiscal Service can legally redirect part or all of the federal refund to satisfy those debts. Many individuals are surprised to find their refund is smaller than the amount calculated on their tax return because they did not receive the offset notice until after the payment was processed. While the tax return itself may have been filed perfectly, these external liabilities act as a mandatory lien on any overpayment. This process is automatic and non-negotiable at the time of filing, making it vital for taxpayers to resolve outstanding government debts beforehand. Finally, many taxpayers inadvertently reduce their own refunds by failing to report all sources of taxable income, which triggers penalties and interest that erode the final payout. With the IRS increasing its focus on digital assets and third-party payment platforms, failing to include income from side hustles, crypto trades, or interest-bearing accounts can result in the IRS flagging the return for an under-reporter inquiry. When the IRS discovers unreported income through its automated matching system, it recalculates the tax due and often assesses a failure to pay penalty along with accrued interest. These additional costs are subtracted from whatever refund might have been due from your primary employment withholding. By being meticulous about gathering every 1099 and documentation for miscellaneous income, you can avoid these expensive corrections that quickly shrink a standard refund. We welcome you to subscribe to our channel for more informative videos on taxes, finances, and investments. Thank you.